Ever wondered if you can start investing with just $100? Whether you're just getting started or looking to build wealth over time, that small amount can go a long way. Let's explore how we can take easy steps to turn that small amount into a smart, manageable investment. No fancy jargon, no complicated formulas. Let's jump right in. You might be wondering, is $100 really enough to start investing? Many people think you need thousands to even begin, but that's simply not true. In fact, starting with a smaller amount can actually be an advantage. It lets you ease into investing without feeling overwhelmed, while still making a meaningful step toward building wealth. First, let's briefly talk about what investing really means. At its core, investing is all about using your money to buy things that you expect to grow in value over time. When you invest, you could be buying a small part of a company, a piece of real estate, or even government bonds. The goal? To make your money work for you, meaning your investments grow over time and eventually make you more money. One of the most compelling reasons to start investing, even with just $100, is the power of compounding. Compounding is essentially earning returns on your returns. It means that not only does your initial investment grow, but the returns you earn also start to grow. Here's how it works. Suppose you invest $100 and it earns a 5% return each year. At the end of the first year, you'll have $105. But in the second year, your 5% return is calculated on the $105, not just your initial $100. So your investment will grow to $110.25 the next year. This process continues, and over time, the growth accelerates. The earlier you start, the more time your money has to grow, thanks to the compounding effect. And here's a cool trick to help you see how fast your money can grow: the rule of 72. Let's say your investment earns a 6% return each year. Simply divide 72 by 6 and it'll take about 12 years for your money to double. An investment that returns 10% each year will take a little over 7 years to double your money. Pretty powerful, right? To get started, you'll need a platform to make your investments. Here are some popular choices. On the desktop side, you have established platforms like Charles Schwab, Fidelity, Merrill, and Interactive Brokers. Charles Schwab has comprehensive tools and low fees. Fidelity has a robust research and customer service. Merrill is integrated with Bank of America, great for banking and investing. And Interactive Brokers is useful for advanced trading for experienced investors. On the mobile side, we have Robinhood, which offers zero commission trading with a simple interface. Acorns provides automated investing with roundups from everyday purchases. Webull features advanced charting tools and extended trading hours. And E-Trade includes comprehensive trading and educational resources. Now that you understand the power of compounding, let's get practical. Where exactly should you put your $100 to make it grow? Here are 5 straightforward options that are perfect for beginners. Investment option number 1. Exchange-traded funds, ETFs, and mutual funds. An exchange-traded fund, or ETF, is a type of investment that combines a collection of different securities, such as stocks, bonds, or commodities, into a single fund. What makes ETFs unique is that they can be traded on an exchange like individual stocks. So, instead of picking individual stocks, you're investing in a broad range of companies with just a single share. This means your 100 is spread across many different assets, which helps reduce your risk while increasing potential returns. However, since ETFs trade like stocks, you typically need to buy them in whole shares, and sometimes a single share can be expensive. This is where the benefits of mutual funds come in. Mutual funds are similar in that they also represent a collection of assets like stocks and bonds, but the difference is that you can invest in a specific dollar amount or buy partial shares. Technically, ETF partial shares are accessible through some platforms, but they are fairly restricted and uncommon, although this will likely change in the future. Both ETFs and mutual funds offer diversification, which means your money is spread across many different stocks or assets. This benefit helps reduce risk because you're not relying on the performance of just one company. Essentially, you're not putting all of your eggs in one basket. Plus, it's much cheaper than buying all of those individual assets yourself. You can easily purchase ETFs and mutual funds through online brokerages. Platforms like Charles Schwab, Fidelity, and Robinhood offer a variety of ETFs to choose from. When selecting an ETF, it's important to look at its holdings, performance, and expense ratio to ensure it aligns with your investment goals. While ETFs and mutual funds share many benefits, they do have key differences. We'll dive deeper into those in another video, but for now, remember that mutual funds are often actively managed, and because they are managed, it means they come with higher expense ratios, essentially the fee you pay for their service. Look for funds with low expense ratios and check their performance over time to make sure they're right for you. Investment option number 2, fractional shares. Now that we've covered ETFs and mutual funds, let's explore another great option for your 100, fractional shares. These are a relatively new investment option that allow you to buy a portion of a stock, rather than needing to purchase an entire share. Here's how they work. Traditionally, stock investments require you to buy full shares of a company. For example, if a stock is priced at $500, you need $500 to buy one full share. With fractional shares, you can invest with a smaller amount of money by purchasing just a fraction of a share. Fractional shares are especially useful for investing in high-priced stocks. Imagine wanting to invest in companies like Amazon or Google, but their stock prices are too high for your 100. With fractional shares, you can still own a portion of these big companies without needing to buy an entire share. This option is fantastic for diversifying your portfolio, as you can spread your 100 across multiple companies instead of investing it all into just one stock. For instance, you could buy a fraction of Amazon, Apple, or Tesla. Modern platforms like Charles Schwab and Fidelity offer fractional shares, making it easy to invest in high-priced stocks and manage your investments directly from your smartphone. Fractional shares have grown in popularity thanks to online trading platforms and mobile apps, allowing more people to invest in big-name stocks with smaller amounts of capital. However, it's important to know that not all investment platforms offer fractional shares yet. Be sure to check if your chosen platform provides this feature before you start. Investment option number 3, bonds. If you're looking for a conservative investment that offers stability and regular income, bonds could be a great option for your 100. Bonds are known for being less volatile than stocks, making them a more predictable choice for those who prefer low-risk investments. When you invest in a bond, you're essentially lending money to a government, municipality, or corporation. In exchange, the issuer of the bond agrees to pay you interest at regular intervals, known as coupon payments, over a specified period. Once the bond reaches its maturity date, you get your initial investment, also known as the principal, back. There are several types of bonds, including government bonds, issued by the government, such as US Treasury bonds. These are considered among the safest bond investments because they are backed by the US government. Corporate bonds, issued by companies to raise capital. These typically offer higher returns but come with slightly more risk compared to government bonds. Municipal bonds, issued by states, cities, or local governments to fund public projects. These often have tax advantages, as the interest earned is sometimes exempt from federal or state taxes. So, what are the benefits of investing in bonds? When it comes to investing in bonds, there are a few key benefits. First, bonds provide regular income. You receive fixed interest payments on a consistent schedule. This predictable income can be especially helpful if you're planning for something like retirement or saving up for a big future expense. Next, bonds are known for being lower risk compared to stocks. Government bonds, for instance, are backed by the credit and taxing power of the government, making them a stable choice for more conservative investors. Another advantage is diversification. Adding bonds to your investment portfolio helps balance your risk. If you have a lot of money invested in stocks, bonds can help smooth out the ups and downs of the market, providing a stable return that counteracts the volatility of stocks. To purchase bonds, you can use any online brokerage accounts, or for government-related bonds, you can simply go on the US Treasury website. When considering buying bonds, here are some things to look out for. The term length. Bonds come with different maturity periods, ranging from short 1-year periods to 3 years in length or even higher. Short-term bonds offer lower interest rates but give you quicker access to your money, while long-term bonds typically offer higher interest rates, but your money will be tied up for a longer period. Also, pay attention to the bond's coupon rate, which is the interest rate you'll earn. Compare rates across different bonds to ensure you're getting a good deal. Remember, Bond prices and interest rates have an inverse relationship. When interest rates go up, bond prices usually go down and vice versa. So bonds might not offer the high returns you might get from stocks or other riskier investments, but they can be a stable and reliable part of your investment portfolio. They help preserve your capital while still providing a modest return. Investment option number 4, robo-advisors. Robo-advisors are automated investment platforms that build and manage a diversified portfolio for you. When you sign up, you'll answer a few questions about your financial goals, risk tolerance, and investment timeline. Based on your responses, the robo-advisor allocates your money into a mix of investments, typically including ETFs and index funds. These platforms use algorithms to monitor your investment continuously. They make adjustments known as rebalancing to keep your portfolio aligned with your goals. This means you don't have to actively manage your investments. The robo-advisor takes care of everything. Benefits of robo-advisors. First, robo-advisors offer hands-off investing. They handle everything from selecting investments to rebalancing your portfolio. Perfect if you prefer not to manage your investments actively. Next, they come with low fees. Most robo-advisors charge significantly less than traditional financial advisors. Some platforms charge as little as 0.25% annually on your total balance, making it a cost-effective way to have your investments managed professionally. Robo-advisors also provide a diversified portfolio. Similar to ETFs and mutual funds, they automatically spread your money across various investments, which reduces risk and increases the potential for steady returns. Many robo-advisors are also customizable. While they are automated, many platforms let you tweak your portfolio by choosing themes like socially responsible investing or adjusting your risk tolerance. To start with the robo-advisor, simply sign up on a popular platform like Betterment, Wealthfront, SoFi, or Charles Schwab's Intelligent Portfolios. Most robo-advisors have low minimum deposits, often as little as 1 or 100, making them ideal if you're beginning with a small amount of money. During the sign-up process, you'll answer questions to determine your investment preferences. The platform will then recommend a portfolio tailored to your needs. Once you invest your 100, the robo-advisor will automatically spread it across a selection of ETFs, bonds, or other assets based on your risk comfort level. Many platforms offer additional features like goal-setting tools for retirement or buying a house, automatic rebalancing, and even tax loss harvesting, which helps reduce the taxes you pay on your investments. Robo-advisors are perfect for those who want an easy, stress-free way to start investing. Investment option number 5, high interest savings accounts and certificate of deposit (CDs). If you're looking for a safer, more stable way to grow your money, high interest savings accounts and certificate of deposits or CDs might be just what you need. Let's break down what each option offers and why they could be a great choice for your 100. High interest savings accounts are similar to regular savings accounts, but with a major advantage. They offer significantly higher interest rates. Your money grows passively over time by earning interest, and these accounts are FDIC insured, which means your funds are protected up to $250,000. So even if the bank faces problems, your money is safe. One of the best features of high interest savings accounts is their liquidity. This means you can access your money whenever you need, without penalties. You can add or withdraw funds as you wish, making it a flexible choice if you don't want your money tied up. For a secure place to keep your cash, especially if you're just starting with savings, this is an easy, low-risk option. Online banks often offer better interest rates than traditional banks, so it's worth comparing different options. Certificate of deposits are a little bit different. They require you to lock away your money for a set period in exchange for a guaranteed return. When you open a CD, you agree to leave your money in the account for a fixed term, which can range from 6 months to several years. In return, CDs offer a fixed interest rate, so you know exactly how much you'll earn by the end of the term. This makes CDs a great choice if you value stability and predictable returns. However, if you need to access your money before your term ends, be aware of potential early withdrawal penalties. Like high-interest savings accounts, CDs are also FDIC insured, so your investment is completely safe. Setting up both of these accounts is pretty straightforward. You can open them at your local bank or through an online financial institution. Keep in mind, online banks often offer higher interest rates due to their lower overhead costs. When choosing a CD, look for one that matches your financial goals. Compare different terms and interest rates, and consider how long you can comfortably set aside your money. For high-yield savings accounts, search for accounts with minimal fees and no minimum balance requirements, especially when starting with a low amount. These small details can make a big difference as your savings grow. Balancing risk versus reward. Every investment comes with risk, and it's essential to balance that with potential rewards. Understanding how different investment options fit into this balance can help you make more informed decisions. Investments can generally be categorized into 3 different risk tiers: low risk, moderate risk, and high risk. Low risk options include things like bonds and high yield savings accounts. They offer stability and predictable returns, but usually with lower potential gains. Moderate risk options include things like index funds and mutual funds. These offer a balance of risk and reward, but with the potential for steady growth over time. High-risk options includes individual stocks and certain high-growth investments. These can be much more volatile than the other 2 options, but in the end can provide much more returns as well. The key to managing risk is diversification. By spreading your investments across different assets, you can minimize potential losses. Diversifying helps ensure that the performance of your one investment doesn't significantly impact your overall portfolio. So as you invest your 100, consider how each option aligns with your risk tolerance and investment goals. Diversify your investments to create a balanced approach that suits your financial situation. The importance of emergency funds. Before investing, it's crucial to have an emergency fund. This is money set aside to cover unexpected expenses or financial emergencies, such as medical bills, car repairs, or a job loss. Having an emergency fund ensures that you don't have to dip into your investments or incur debt when life throws a curveball. A common recommendation is to have 3 to 6 months worth of living expenses saved in an easily accessible account. Emergency funds are best kept in a high-interest savings account or a money market account. These options offer better returns than a traditional savings account while keeping your money easily accessible. Having an emergency fund offers several key benefits. First, financial security. An emergency fund acts as a safety net. It gives you peace of mind knowing that you're prepared for unexpected expenses, whether it's a medical bill, car repair, or job loss. This financial cushion helps you maintain stability even when life throws you a curveball. Second, avoiding debt. With an emergency fund in place, you're less likely to rely on credit cards or loans when an unexpected expense arises. This means you avoid accumulating high-interest debt, which can be a significant financial burden. Lastly, investment focus. When you have an emergency fund, you can invest with more confidence. Knowing that you have a buffer for unforeseen expenses allows you to focus on growing your investments without worrying about having to access them prematurely. To get started, begin by setting a small amount. It should be manageable and it should be consistent. As you save more, gradually increase the amount. Make building this fund a priority before you start committing significant amounts to other investments. Investment strategies for maximizing returns. First, set goals. Start by defining your investment goals. Are you saving for a short-term expense, like a vacation, or are you building long-term wealth for retirement? Clear goals will guide your investment choices and help you stay focused. Next, make regular contributions. Even small, consistent contributions can have a big impact on your investment growth over time. If possible, try to add your investments beyond the initial 100. Regular contributions help compound your returns and build wealth faster. Next, rebalance your portfolio. Periodically review and adjust your portfolio to keep it aligned with your desired level of risk and return. Rebalancing ensures that your investments stay on track with your goals and help managing your risk. Additionally, monitor your performance. Keep an eye on how your investments are performing. Use tools and reports from your investment platforms to assess whether your investments are meeting your expectations or if adjustments are needed. Make sure your portfolio is diversified with a variety of assets to reduce risk and think of investing in the long term. Continue educating yourself. Constantly learning about investment and financial strategies can always benefit you. Staying informed about current market events and global conditions will also help throughout your investment journey. And remember to have a long-term mindset, and again, don't put all your eggs into one basket. So as you dive deeper into investing and implementing these strategies, remember that building wealth is a journey, not a race. Each small action you take today can lead to substantial growth in the future. If you enjoyed this guide and want more videos to boost your financial journey, hit that like and subscribe button. And remember, keep investing in yourself and have a fantastic day.